Hello, welcome back. We're now moving on to frequency distributions. So a frequency distribution is also called a one-way table. All it is a tabular display of data that's constructed by counting the observations of a variable by distinct values or groups. So for example, if we look at the stock exchange, what we can do is we can count all the IT stocks that are on the exchange, and we can see how many IT stocks there are, or we could count and see how many financial stocks there are, how many energy stocks, etc. Or what we can do is we can tally the values of a numerical variable into a set of numerically ordered bins. And these bins are also called intervals or buckets. So we're going to do this scenario on the next slide, and then it'll become much more clear. And also, we'll go through these definitions here quickly, but they will become a lot more clear when we do our example on the next slide. But let's go through them first. So the absolute frequency, this shows us the number of observations that fall within each bin. And then the relative frequency of observations in a bin, what we do is we take the number of observations in the bin and we divide by the total number of observations. And that's going to give us the percentage of all the observations that are in each bin. And now with the cumulative absolute frequency, so cumulative means we're going to add up. So if it's cumulative absolute frequency, all we need to do is add up the absolute frequencies. These ones over here, we're going to add them up as we go from the first bin to the last bin. And then the cumulative relative frequency, this means we're going to add up which ones now? We're going to add up these ones, the relative frequencies, these ones, as we go from the first bin to the last bin. And this is going to give us the percentage of observations that are less than the upper limit. And some people call it the upper bound of each bin. So let's do the example, then all of this is going to become clear. So we've got Riverside Retail. They've had the following annual returns on their share price over this 10-year period. So we can see some years were pretty bad, like 2010, they did -8%, but then some years were good, like 2015, they did 14.8%. So here's our return bins or interval or our buckets. So we can see they're going up in increments of 5%. And now remember the absolute frequency. What this does is it shows us the number of observations in each bin. So let's just do it for one or two bins, the absolute frequency. So let's do it for the first bin from -10 to -5. So how many times was the return in this range? Well, if we look here, down here, just once was there a very bad interval. And then let's do it for the next interval, which is -5 to 0%. Well, we can see over here that -4.2 is in that range there. And then this one over here. Okay, so twice the return was in this bin over here. So what you guys can do then is just go through and just double check that for the rest of the bins, you'll see that there was 4 times the return was in this range, twice the return was in that range, and once the return was in the very good range when we had that good year there in 2015. Right, so now the relative frequency. So remember the relative frequency, all we do is we take the number of observations in each bin and we divide by the total number of observations. So if we add up here, the total number of observations, we're going to get 10. So that's why we're dividing the number of observations in each bin over there. For example, for the first bin, there's only one observation in the first bin. We divide by the total number of observations. So we can see that 10% of the returns were in this bin. And we can see here that in this bin, the 0 to 5% bin, most 40% of this is our biggest relative frequency. So 40% of the time, the return was between 0 to 5%. And now remember cumulative absolute frequency. So cumulative means we add up. And so if it's cumulative absolute frequency, what are we going to do? We're going to add up the absolute frequency as we move from the first bin to the last bin. So we're going to be 1 there, of course, for the first bin, and then we're going to take 1 plus 2 is 3, and then 3 plus 4 is 7, etc., etc. And then the last column is the cumulative relative frequency. So this means we're going to now add up which one? We're now going to add up the relative frequency as we move from the first bin down to the last bin. So if so our first bin is 10%, and we take 10 plus 20 is 30, and then 30 plus 40 is 70, etc. And remember what we were saying on the previous slide. What does this tell us? This shows us the percentage of observations less than the upper limit of the bin. So the upper limit here of this bin, for example, is 5%, and our cumulative relative frequency is 70%. So what does it mean? It means 70% of the observations are less than 5%. Good. So now what we can do is we can go on to the contingency table. So what is this one? So this is a tabular format that displays the frequency distributions of two or more categorical variables simultaneously. So this is used for finding patterns between the variables. So if we have a contingency table for two categorical variables, we call this a two-way table. And the contingency tables, they can be constructed by listing all the levels, also called them the categories of variables as of bigger pardon. We're going to list all the levels or the categories of one variables as rows, and we're going to list all the levels of the other variable as columns. That's all we're going to do. So if we've got a contingency table that has got R levels of one variables in rows, so there's the R and the R together, and then we've got C levels of the other variables in columns, so there's our C and our C, then we're going to call it a R by C table. We are going to do an example in a minute. So each variable in a contingency table, it's got a finite number of levels, which can be either ordered, which is our ordinal data, or unordered, which is our nominal data. And that's what we've discussed then in the previous class. And the data, it can be displayed, the data in the cells can, there's a bigger part, the data displayed in the cells can be a frequency, which is a count, like we've looked at on the previous slide, like an absolute frequency. Or we can do a relative frequency. So remember, if it's a relative frequency, then it's going to be a percentage. And that percentage can be based on either the overall total, the row total, or the column total. So we're going to do a table now where we're going to first do the frequency or the count. And then after we've done that one, then we're going to do a relative frequency table, which is going to give us the percentages. So we're going to do both of these, and this is going to clear all of this up. So let's do our example. So here we've got a 4x3 contingency table. So remember that is our R there. So we're going to have 4 rows, and then we're going to have 3 columns. So it's R by C. So we're going to have 4 rows here, and we're going to have 3 columns there. So it's going to be a 4x3 contingency table that's summarizing the number of stocks, and then remember that is our frequency in a portfolio of 200 stocks. And we're going to summarize now using 2 variables. Our first variable is going to be the sector. So we are going to, this portfolio is invested into 4 sectors, or 4 sectors on the stock exchange. So the portfolio is in IT stocks, financials, consumer staples. So consumer staples are things like food and those basic things. So we'll talk more about those when we get to the equity section. And then materials include things like resources and mining and that type of stuff. So of course, a portfolio wouldn't just be in 4 sectors on the stock exchange. We would be more diversified. So we would have some retail stocks and some energy stocks and more sectors, but we're just keeping it simple here by limiting ourselves to 4 sectors. And then the other variable we're going to look at is the company market capitalization. So we haven't discussed this yet, but we will be in, we see this all over the place. So what a market capitalization is, or market cap for short, it's the market value of the company. It's just the value of the company. And how do we get that? We take its share price, multiply that by the number of shares in issue, and that gives us the market cap or the value of the company. So we're going to look at 3 levels for this. We're going to have small cap stocks. So small cap stocks, we generally, and we'll use the general classification, is that the value of the company is less than $2 billion. Mid cap is between, let's call it between $2 billion and $10 billion. And then large cap, its value is over $10 billion. So here we go. So now we're doing the frequencies by our sectors here, which are our rows. We've got the 4 rows there, and market cap. The market caps are our columns. We've got the 3 columns for the market caps. So what I want to do now is instead of going to the next slide, I want to just, I've got my book in front of me. I want to leave this slide on here. And so this is our next slide, but I want to go back to this slide over here that we've just covered, and then we can go through the next slide while we rather keep this one on the screen. So these are the observations that we can make. So for example, we can see there are 40 over here. There are 40 mid-cap IT stocks, and this is the portfolio's largest subgroup in terms of frequency. So it's the largest. So the 40 is the largest one. So the largest subgroup we've got is mid-cap IT stocks. And then these data, they call these joint frequency, because we join one variable from the row, which is over here, the IT, for example, which is our sector, and then the other variable is from the column. So that is why it's called a joint frequency. So we are counting then, the number of observations that are in each subcategory, or each subgroup, we could rather call it. And then the joint frequencies, what we can do, we can add them here across the rows and the columns, and then these corresponding sums, we call them the marginal frequencies. So for example, the marginal, if they ask us, what's the marginal frequency of IT stocks, all we need to do is add. All we need to do is add across the 3 levels of market cap. So we'll add the 20 plus the 40 plus the 10 there. So we can see that there's a total of 70. There's a total of 70 IT stocks. And then if we add the joint frequencies, let's say for this one, of mid-cap stocks across our 4 sectors, then that's going to give us the marginal frequency of the mid-cap stocks. If we take 40 plus our 20 plus our 20 plus our 10, we can see that there are over here, there are 90 mid-cap stocks. So the largest marginal frequency by sectors, our sectors over here, is the IT stocks, because there's 70 of them, and they are obviously the other sectors, we've got less of those in the portfolio. And then the largest marginal frequency among market cap, we can see, is the mid-cap stocks. We've got 90 mid-cap stocks. We've only got 60 small caps and 50 large caps. Great. So that is what it looks. That is what our contingency table looks like for frequencies. What we're going to do now, so that we've covered, what we're going to do now is we're going to express the frequency rather in percentage terms. And remember from what we did a few minutes ago, if we do in percentage terms, then we're going to do it as a relative frequency by dividing the joint frequencies. So we can divide the joint frequencies by total count, which we're going to do on the next slide. Then after we've done that, then we're going to divide the joint frequencies by the marginal frequency on a row, or we can do it we can divide by the marginal frequency on a column. So let's just jump to it and we'll see it's not that bad. So here we've got now the contingency table using relative frequencies based on, we're using here total count. So remember, the total count, there were 200 stocks in this portfolio. So this is now, so because it's relative frequency, we've now converted the numbers into percentages. So let's say, for example, work out this one, the mid-cap IT stocks. The mid-cap IT stocks, we saw earlier that I think how many of them were there? There were 40 of them, right? So they make up the largest proportion of the portfolio. Okay, there it is there. There were 40 of them. If we just want to double check, there we go. There were 40 of those guys there. Divide by the total of 200. So we can see that they now make up 20% of the portfolio. They make up the largest proportion of the portfolio, the mid-cap IT stocks. And then if we want to see, you know, what about all of the IT stocks? Well, they make up 70 out of 200, which is 35% of the portfolio. So if we just go and double check there, we can see there we go. Remember, we had 70 IT stocks in total. And then we can quickly see that that makes up 35% of our portfolio. Right. So now what we're going to do, if we're still going to use relative frequencies, but now we're going to base it on marginal frequencies of market cap, and market cap is our columns. So we're going to base it on as a percentage of our columns. So let's do it then for our mid-cap stocks. We're looking at the columns here, the small, the mid, and the large. So in this little example, we're doing for mid-cap stocks. So let's do it then for IT first. So remember the IT, there were 40 of them, and there was a total of 90 mid-cap stocks. So there we go. So it's 40 over 90. So now we're doing the relative frequency for the column. So for IT, it's going to be 40 over 90. For financials, it'll be 20 over 90. Consumer staples also 20 over 90, and materials will be 10 over 90. There we get the percentages then for that column. So let's have a look where we are now. There we go. Okay, so that's what I was saying. So the financials, they're going to make up 22%. For the mid caps, the consumer staples also 22%, and the materials only 11%. So what can we then conclude? We can say that this portfolio, we can describe it as a mid cap orientated portfolio. So if we just go back here as well, we can see quickly. There we go. It's mid cap orientated because it's by mid caps of 45% versus 30 and 25 for the other caps. And with the biggest weighting in IT. So we can see there, we've got 35% in IT, and the other sectors are lower. Great. So what we now need to look at, the last thing we need to look at in this class is the applications of a contingency table. And the first thing we can use it for is a confusion matrix. And hopefully we're not going to get too confused by this, but only kidding, it's not so bad. So what this does, it evaluates the performance of a classification model. So we've got this little example here. We've got a model that classifies 1,000 companies into two groups, those that increase their dividend payments and those that do not increase their dividend payments. So this confusion matrix for displaying the model's results, it's just going to be a 2 by 2 table like we'll see over here. It's 2 by 2 table over there. And it's going to show the frequency of actual dividend increases versus the model's predicted frequency. So we're going to compare actual dividend increases versus the model's predicted frequency of dividend increases. So we've got the predicted increases over there and with the actual increases over here. So if we look over here on the right-hand side, we can see what this model is telling us. It correctly predicts 710 cases of dividend increases. Why? Because here we've got predicted increase, yes, and in actual, so the prediction was for an increase in dividend payment, and what actually happened? Yes, the dividend did actually increase. So it's correctly predicting 710 cases of dividend increases. So when we've got a yes and a yes corresponding, then the model is working. And what is it also correctly predicting? It's correctly predicting 260 cases of no dividend increases. So here, the predicted increase was for no increase. And what actually happened in the real world? Yes, there was no, in 260 cases, there was no increase in dividends. So there again, the model is working. It's correctly predicting 260 cases of no dividend increases, because the prediction was an increase in dividend, and what actually happened, beg your pardon, their prediction was for no increase in dividend, and what actually happened, there was no increase in dividend. But now, when we've got, so there we've got a no and a no corresponding, and that is also meaning that the model is working. So if we have a yes and a yes corresponding, or a no and a no corresponding, then the model is working. But when we have a yes or a no together, or a no and a yes, that's when the model is not working. So over here, let's have a look at this one over here. So the model, it incorrectly predicts 20 cases of dividend increases where no increase is actually incurred. So that's a mistake. Why? Because the model was predicting an increase, but in the real world, the increase actually did not happen. So that is an incorrect, that the model got wrong. So there we had a yes and a no corresponding. So that was a mistake from the model. And then lastly, it also now incorrectly predicts 10 cases of no dividend increases where increases actually incurred. So that's over here. So the model is predicting that there is no dividend increase, but what actually happened in the real world, there actually was an increase in dividend. So that is also a mistake. So there we've got a no and a yes, and that is then was instance where the model was not working. But we can see the model overall looks pretty good, because the correct predictions over here, these two, far outweigh these two incorrect predictions. Right, and then the last thing that we're going to need to, the other, or not the last thing, but the other application, this is the last thing we're doing, the applications, but the last, the other application we need to focus on is look at the potential association between two categorical variables. So in our early example that we did, we can investigate whether the distribution of stocks by sectors is independent of the levels of market cap. So if we take the IT sector, if we go back there, you can see that the small and the mid cap stocks, so the small in the IT sector was 20 and the mid caps were 40. So this means that 85% of the stocks are small and mid cap stocks in the IT sector. So it looks like the distribution of stocks in the sector, it looks like it is not independent of market cap, because the small and the mediums, they are dominating by far. So what we can do is we can perform what we call a Chi-square test of independence to test for a potential association between categorical variables. Now, I don't want you to panic now, because we are going to be doing the Chi-square test in a lot more detail when we get to hypothesis testing. So, and that's what I'll say this down over here. So we're just going to go through this quite quickly. And then once we've done hypothesis testing, maybe you can come back here and you'll see it's actually not so bad. So what this does, it involves using the marginal frequencies in the contingency table to construct a table with expected values of the observations. And then the actual values and the expected values are used to derive the Chi-square test statistic. And then what we do is, once we've got this test statistic, it is then compared to a value from the Chi-square distribution. And we call that value the critical value. And we're going to talk, we're talking a lot about that when we get to the hypothesis testing. And we get this critical value for a given level of significance. We often use 5%. That's our most common level of significance that we use. And then this is the bottom line, that if the test statistic, if it is greater than our chi-square distribution value, which is our critical value. So if the test statistic is greater than this critical value, then there is evidence to reject. We're going to reject the claim of independence. So if we're going to reject that there's independence, what does that mean? It means there is going to be significant association between the categorical variables. Great. So that's then the end of that class, and we'll see you guys then in the next one. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.